Hey everyone, welcome. Good to see you guys. Hope you had a wonderful Friday, and it's good to be back after a couple of days of missing. I've been traveling, I'm still traveling, and that's why my video is off because I'm on the hotel Wi-Fi and it's not that fast. So I'm just trying to maximize the bandwidth for sharing of the screen, and hopefully everything is good. It seems like the delay is a little bit larger than normal as well, probably due to that internet speed, but we'll make it work. Hey, Steven, good to see you. And let's see, hopefully, if you have any trouble hearing me or if the audio is weird, just please let me know and I'll see if there's anything I can do about it. So this week has been really exciting uh, in terms of volatility, at least. So what we see is that we didn't get that much direction. If we look at the close on Monday versus the close of today, it really isn't all that much. We just swung really wildly every single day. And actually, every day's close was actually pretty much in a very small range as well. So we talked about this week, the strongest possibility was high volatility, large range, chop sideways, staying inside the high and the low of this previous Friday. And we got exactly that. And so far, the way that the market has closed this week, we're probably at the very least going to start next week in a similar way. There's really nothing has really changed in the markets except this giant amount of volatility that has hit. So that has increased in the IV. Initially, when if we talked the Gamma report, Chris Pulver and I talked on Gamma report, I made the comment that, well, market makers lost a lot of money here. And so it's probably going to be a little while before we see that IV come down. And that proved to be true this week. And actually, yesterday and today, that VIX actually started to go up. And so we saw today a surge upwards, and yesterday a surge upwards. And today we spent most of the time way up here. It was only the last maybe a couple of hours where this really came back down, but we're still at 20.77. So we're not out of the woods yet. This is probably going to continue at least another couple of days. Uh, Market makers can recover their loss on Friday. But what we also need to be aware of is that the realized volatility actually matched the implied volatility. And that's not always the case. If we look over at SPY back during Liberation Day, actually, Liberation Day, okay. So Liberation Day over here, if we're counting the gap here, so that was a really large move. If we look at from here to here, and then from here to here, also very large, here to here, large, large, large. But then starting on this day, after we got that Trump announcement that he was delaying everything 90 days, these bars look almost the same as these bars, these two bars. And then the following several bars are actually smaller and they're more in line with this. So we started to get back to normal realized volatility immediately after this large green bar. So on April 10th, we already got normal realized volatility. If I look at VIX, if I look over here, April 10th, you see that was this day right here. It was not normal VIX. 11th was not normal VIX. 15th, 12th, 14th, 15th, 16th, 17th, or 21, 22, 23, all the way until here, May 12th. Could we say that we finally got under 20 on the VIX? Took several weeks, actually, almost a month. Actually, a month, because we're talking about April 10th, and this was May 12th. It took a whole month for that implied volatility to catch up to the realized volatility. And we see that is tends to be the case. the realized volatility will collapse far sooner than the implied volatility, because the implied volatility, one of the big clues or one of the big pieces of implied volatility is realized volatility. So we haven't seen that realized volatility come back down yet in the SPY. So none of these bars, well, you might argue that this looks similar to these bars right here, but remember, we have to count the gaps. So if we say, if I go from here to here counting the gap, that's nothing close to from here to here counting the gap. Okay, and then we're counting the gaps here, or the range, the high and the low plus the gap. So these are still much larger than any of these. So that is why I said I don't expect the implied volatility really to come back down until mid next week at the very earliest. But from what I'm seeing, it's probably going to last the entire week. So we've got probably at least another week of large realized volatility, which will keep VIX elevated. Not to say that it can't creep down to 19, 18, maybe 17, but chances are, we're probably going to stay in this plus 20 region and maybe all the way down to 18 is what I would guess. So we're in for some high volatility, and we need to be able to adapt and move and realize that our normal MO does not apply to high volatility. So your technical analysis, your technical setups, bouncing off of this moving average, crossing this, or whatever indicator that you're using, it's not going to be that good. It's going to bust a lot more often than your statistics suggest. So if you say, oh, this setup normally has 70% of the time it's going to bounce off of this moving average, you can't expect that anymore. It's going to go a lot closer to 50-50. So you want to be very, very careful about putting on positions. And if you do put on positions, it's probably a good idea to go in smaller size. Hey, Tim, good to see you at PXEIM. Good to see you also. And Peter, good to see you guys. So we just want to be hyper aware of that, right? So there are certain things that we can do to modify in order to account for this new risk that we didn't have in the markets for at least since April. And then we don't see it happen all that often in the markets. And that's why a lot of people get into trouble in this regime, because they try to trade it like they normally would trade. And we just don't see this that often. So people don't realize that they need to change their trading. So basically over here, we needed to change our trading. Over here, we needed to change our trading. And here, actually, it was only a couple days. So, if you didn't change your trading during this time period, it probably would have been just fine. But over here, after April, all the way almost to July, a lot of that time period, we should have changed the way that we were trading. And then over here, it's just a few days at a time normally. And every once in a while, it's a few weeks. And so we want to be very, very, very careful and make sure that we know how to trade appropriately and how to adapt our systems appropriately during these time periods. Where do I see gold and silver? That's a good question. Well, they're seeing volatility just like everything else. Okay, so if I go over and I look at gold, with these big gap ups, if we include the gap plus the movement, these are very large bars compared to over here, right? The gold, though, has broken out of this pattern right here that I drew. And so now it's flying up. And what you'll notice is that if I go back to over here, 2020, it did the same thing, okay? So if I look at that same pattern, and the only reason why I'm looking at a pattern is because it's a pattern of institutional accumulation. And that matters. The institutions are what drive markets. So one thing that I heard today from one of my mentors is very, very, very relevant. And he said, well, you got to know who's in control. And the winners are always the people who are in control or who can spot and follow who's in control. Well, in the markets, especially when we're looking at something like a commodity, when we're looking at large cap stocks, when we're looking at treasuries, institutions are in control. Treasuries, you might argue that the Fed or the US Treasury is in control. But for the most part, it's institutions are in control. You will see that sometimes the Treasury market does not agree with the Fed. Right? For the Fed keeps trying to lower rates, and rates were persistently high over here. Finally, it's starting to break. And so the Fed isn't always in control of the bonds either. So who's in control of the markets? The vast majority of the markets, the only place where they're not in control is your small cap and penny cap stocks. So institutions are in control. And we've got to know what institutions are doing. Since we are not institutions and we are not in control, the only way that we can get out on top is to realize who's in control and who is moving the system, and to be able to follow and watch for the signals of exactly what they're doing. And this is one of them. This is a very clear and recognizable pattern of institutions. Okay. Okay, so we got that. We broke out, and then we went for one all the way up here until we saw that same pattern play out over here. You can argue that this actually is another one. It's not as picture perfect, but it is there. We got a false breakout right there. So it's there. And it is to a smaller extent right here also. Okay. So once we see this playing out, and we know institutions are here, and if we look at this level also, we see institutions in here over and over again. This one's not as good. We could call this an extension, actually. This one right here that I drew earlier is just the end of this one. This one played out super long, 2011, all the way to 2024. But 2020 was where they really started picking it up, like the frequency that they were playing around it here. So that was COVID. So obviously COVID, flight to safety, that's where a lot of institutional interest and public interest in gold started to happen. So we see this over and over again, and it breaks out, and then we get these smaller patterns of accumulation, and then they break out, then pattern of accumulation, breakout, pattern of accumulation, breakout. This one has broken out way more than the last two small ones. And normally what we see is that after a certain period of time, you will go into this period of consolidation again. And so that's what we're waiting for. So I don't see gold hitting that period of consolidation yet, because it hasn't. Maybe, who knows? You can't say, we won't know until after the fact, but maybe this is the beginning of something like that. Maybe. This is pure speculation. I'm not saying this is what's happening. But at some point, whether it's here or higher, something like this is going to happen again. And for anyone who missed this big move up in gold, that's your chance to say, okay, now I have another entry before this thing starts shooting up again. Are we confident? Are we sure that it is going to do this and shoot up again? So far, yes, because there is a lot of money that is afraid right now. There are people who believe, and including institutions, that believe that there is recession. Whether or not it is imminent, if there's recession coming up in the next couple of years, the institution is going to start to prepare themselves. The cycle for an institution is far longer than the cycle for a retail trader. They're playing a much longer game than your retail trader is. I was about to say your average retail trader, but just about any retail trader. They're playing a much longer game than any retail trader out there. So they're going to start preparing and mixing their balance of assets far sooner than any retail trader is going to do. So this is my expectation is that we haven't seen it. Now, I could be wrong. So how would I know if I was wrong? Well, if I was wrong, then what will happen is it is rare for us to just be wrong like that. Okay? It'd be really, really unlikely. It basically doesn't happen. Why did everything come back? Let me delete this again. Okay. So what is normal is maybe something like this. Okay. In which case I know there's a sell campaign going on. But in any case, it's not going to fall straight down. Just like there's areas of consolidation on the way up, there's going to be areas of consolidation on the way down. So if I see this, okay, then I'm wrong and I can get out on this breakdown. Or what'll happen is it'll come down to a certain level where there's support. Okay. And then if I see it go down and then consolidate, that's my first clue that, uh-oh, we could be at the beginning of a sell campaign. And then I would be more sure if it broke down like that. Okay. Because the pattern of accumulation is not come down, consolidate, and then go up. That's not the pattern of accumulation. What would be the pattern of accumulation is here, we go down and we might chop a little right here and then retest the same level, the high that we saw before. Not consolidate down here. It would consolidate with the same high. Okay. So there are exceptions to that. I'll show you like this one. Okay. It did reach a higher high and then it started to chop and consolidate a little bit lower than that high, but it wasn't a full pullback down to an important level and then chop. Sorry, I misspoke. It was a pullback to an important level and then chop at a lower high. Okay. So that would have been a caution sign. I don't know for sure, but it broke to the upside. So we were fine. So here we were cautious. If it broke to the downside, then we'd be out. We say, okay, we're at the beginning of an institutional selling campaign now, instead of a continuation of an institutional buying campaign. Okay, so far, gold looks amazing, and we don't know where it's going to start chopping its or start doing its sideways consolidation. This being a fairly large red bar is a clue that it might be, but we got it right here too. It only lasted a day, just kept on going up. So we don't know. We don't know yet. So as of right now, the momentum is forward and upwards. So gold, I would not be selling gold if I had gold right now. I actually have several friends over the last couple of days. Should I sell my silver? Should I sell my gold? I would not yet. I don't see any signs of this stopping yet. So this is looking very good for gold. Is this a time to buy? No. I would wait until I started to see some consolidation. Okay. And then consider what might, depending on how that consolidation looks, consider what my buy-in strategy is going to be. So we don't know how that is going to look. Is it going to look like these? In which case, could you say that, hey, you could buy right here? Sure, you could do that, but you're going to be suffering sideways chop for quite some time. So I wouldn't buy in right here with an option. I'd be fine buying in the equity or the actual gold, physical gold right here. That's no problem because you're going to hold on to it for a really long time anyways. But this is a terrible entry for an option. The best entry for an option would be right here, right as it's breaking out of all of this consolidation, because then you get this without worry about the time decay. Okay? So here, if you're doing the equity or physical gold, breakout if you're doing an option. And it's really the same thing for silver. Same thing, same thing. Big red bar, but we had that huge red bar, all it was bounces off of the EMA 8. The slightly different thing about this bar is that the EMA 8 is sort of flattening right there, but we also got that right here where it flattened. Okay, so far there's no sign that this is actually consolidating yet or coming back down. So the momentum is all upwards, and until we see an actual sideways consolidation, that's going to be the continued expectation. Okay. I'm looking at a 1-day time frame. 1-day time frame. Okay. Hi, JFACADA, J Fakata, JF Akata. PXEIAM says we're heading to 10,000 an ounce on gold spot. Gold spot. Yeah, I mean, given what we're seeing right now, I'm not going to say it's impossible. Yeah, I mean, there's no slowdown in this. And if we just have more series of consolidations and upwards, a couple years from now, we could be at 10,000 for sure. Yeah, as long as that pattern keeps on going. And if we look at macro factors, there is an argument for gold hitting 10,000. It's not way off base because the US dollar basically is going to determine, the likelihood of that happening. And what we're seeing is this weakening of the US dollar is flattened out, but a lot of people say Liberation Day for sure, but it started before that, right? It started basically beginning of January. And if we really want to look at it, it really started back in 2023, end of 2022, where the US dollar really started to weaken and it consolidated over here a little bit, and then it weakened again. Okay, so if we look at the dollar, if we said this was a run up and then this started to consolidate, okay, that's when I would be worried about the US dollar. And since it never, this doesn't apply because we're not expecting institutional accumulation inside the US dollar. Okay. But we don't buy a whole bunch of US dollars and sit on them. Or even currency traders, they don't sit on large positions of currencies for years and years. They flow in and out of them. So currencies, we can't apply the same pattern to currencies. So what I'm saying is, if this was a chart of something that a institution would accumulate, like gold, then and we had a run up and then a pullback and consolidation right here. Well, so far I haven't seen it. So the highs here were bouncing down here and not up here. Oops, not right there. Okay. And so this is a warning sign for me. And then here, it looks like a breakout, but it turned out to be a false breakout. And then it started to go down. And once we went over here, now we're concerned that this is actually a long-term downtrend. So again, I can't apply this to US dollar. I can't apply this to the DXY and expect it to be accurate. I'm just saying, if this was an institutional accumulating asset, then I would be very concerned. But as it is, I'm still concerned. Not because of this pattern, but because of the macroeconomic factors, the fact that that Trump started this whole thing, the whole road with tariffs, and people are beginning to believe less in the U.S. dollar and the U.S. government, and the Treasury's having problems funding itself through bonds, and Trump was like, hey, we gotta lower rates, lower rates, lower rates. And forever the bond market was going against him, no matter what they did. Even if when the Fed was lowering rates, the Treasury bond yields were still going up. And that all of that is putting pressure on the US dollar and going down. And also the existence of cryptocurrencies now, where people are more willing to, institutions now are playing in the cryptocurrency game. So the dollars that would have been allocated to treasuries normally, are some of them at least, are being allocated over to cryptocurrencies. So if this US dollar keeps breaking down, then and there's less international demand for US dollars, and what is the largest driver? What is the largest demand for US dollars? It's US treasuries. So if there's less demand for those US treasuries, there's going to be less demand for US dollars. And we're going to see this continue to move downwards. And then an inflation of asset prices like gold, like silver, like palladium, like energy, like oil, like real estate, like basically everything uh, it looks like everything is blowing up, but actually it's the US dollar coming down. And that's what we're getting right now. Crypto is up, although not short term, but crypto, it did hit its all-time high fairly recently. And then, gold is up, silver is up, bonds are beginning to go up. And stocks are way up. Basically, all assets are up. It's because of this breakdown in the US dollar. Not 100% because of it, but a large part because of it. So yes, gold is in a cycle where it can run for several years, and metals tend to run for several years. They don't just pop up for a few months. When they go, they start to go for a few years for a lot of the reasons that we already just talked about. Um, Totally agree, trying to hold some physical metals. How do you see crypto in the short term and long term? One should invest in Bitcoin or other cryptos. Okay, so since we now have institutional players in crypto, they are accumulating, but what are they accumulating? It's just like with stocks. A institution cannot go in and go to a penny stock. This is the only penny stock I'm familiar with, because They were trying to hire me as their CEO for a while. But this is, see this? There's no institution that is going to accumulate this. They can't. It's 5 cents or 3 cents, and they could just buy the whole company. If we look at the market cap on this thing, JFIL, where's my search bar? There it is. Okay. Yeah. Internet's just too slow. If I look at this thing and I look at its market cap, it's not even telling me. Okay. All right. So how many outstanding shares are there? Outstanding shares outstanding. Oh, they also don't. Okay. Well, in any case, the market cap on this thing is probably sub 10 million. Okay. An institution could just buy the whole thing. That wouldn't, and not even blink. It wouldn't even necessarily be a full allocation. It'd be, and then suddenly you own the entire company. Well, you can't make any money off of this as an institution. There's no way. There's zero. If there's zero possibility that even if they bought at 3 cents and exited at 12 cents and 4x their money, it's going to be a blip in the money that they control. So it'd be meaningless for them to play in this space, waste their time, effort, energy, resources, analysts, all of that they have to pay for to go in on something that they can't even make any money off of because the size is just too small. It's sort of like, hey, I make, just say I make $100,000 a year. Are you going to spend 8 hours a day looking for pennies on the ground? You're not going to do it. It's not going to be worth your time. Are you going to spend 8 hours a day walking around collecting aluminum cans and plastic bottles and recycling them for a couple of bucks? You're not going to do it. It's not worth your time, effort, and energy if you can just go do your regular job and make $100,000 a year. But it is worth the time, effort, and energy for people who don't even have a job, for people who are homeless, who are people who only make minimum wage, but they only get 10 hours a week, or they get 20 hours a week. They don't get full time. So those are the people where it's worth that time, effort, and energy to go and do something like collect aluminum cans. It's not worth it for someone who's salaried at 100,000 plus. Same thing. This is an aluminum can in the stock market. And there's no institution that's going to walk around collecting this and trying to make money off of this. So when an institution comes in to a market, they are going to dominate with the number of dollars inside of that market. What is going to happen is that why is there very little interest in a stock like this and huge amounts of interest in a stock like this? It's because institutions are playing. A huge amount of money is coming in here and it's being exchanged every single day. And so institutions are in here, but so is retail. Same with Tesla. Okay, same with Apple. Same with all of the Mag 7s. There's a huge institutional footprint. There's huge amounts of money being flowing right here, huge amounts of money that can be made right here, and retail piles in. Okay. So if we apply the same thing to cryptos, institutions are going to come in. They can't touch any of your altcoins because every single one of those altcoins is a small cap or penny cap stock. And there's no VIG in it for them. There's no profit in it for them. So they're going to go to the coins that can handle their size, and they're going to play over there. And that's basically Bitcoin, Ethereum, and XRP, and maybe one other. It's like top market cap cryptos. Okay, Bitcoin. What is this? 2 trillion? What is Yep, 2 trillion. And over here is like yeah, 465 billion, 181 billion, 150 billion. But basically, we're going to be in this top 5 or 6. Okay, 75 billion is nothing. Okay. I mean, what's the market cap on your average SP5, SPY, S&P 500? Okay, 75 billion. Yeah, they're not even going to. So even XRP is kind of like, So really, the only really ones that could really handle the size is Bitcoin, and then Ethereum, just because we need some diversification. Right? It can't all be in Bitcoin. You can argue Ethereum also. But if we do have lots and lots and lots and lots of institutional participation, then they are going to consider and put in money and therefore boost up the market cap of things like Tether, BNB, XRP, and Solana. Okay, that's about it. That's about it. And there's got to be a good business behind it also. So, in my opinion, and this is my opinion only, and I am not a crypto expert, but I am a market expert. I am a financial market expert. I am an institutional financial market expert. So, in my opinion, this is where all the attention is going to be. And I would not personally want to play in any of these down here because there's no institutional money down there. Just like, unless I have a very specific reason, I don't play in penny stocks, because why would I play in penny stocks when I know exactly how institutions operate and I have a huge edge in the areas where they operate, whereas I don't necessarily have that huge edge in the small cap stock or the penny cap stocks. So, down here, you're just playing against other retail, and who knows, Fartcoin. Why the hell did that take off? I don't know. Why was that even a thing? I don't know. Because people, or I don't know. I don't even want to say anything about it. Okay. It's ruled by the individual emotions, excitement or greed or fear of an individual versus the excitement and greed and fear of a institution, which is a lot more steadfast, a lot more predictable than random individuals. Okay. So I believe there is still a very good future for Bitcoin and Ethereum. I'm not 100% sure about all of the ones down here, down to Solana. And then I have zero interest in anything below that. But that's just me. Okay. I'm sure there's a lot of people who disagree with me and a lot of people who run funds who are collecting stuff down here. Okay. But again, how much money can you really be controlling? How big is your fund? Right? If you tell me I run a fund of altcoins, I would tell you you're not a very big fund. That you already told me how big your fund is. You already told me everything I need to know about the the size of your fund and how it operates just by what you're playing in. I already know you're not that big. All right, you're probably sub 100 million. I'd be very surprised if you're above 500 million. You're a small fund. $100 million hedge fund is puny. You're not going to get any institutions in there. In fact, until you hit, is it 25 or 100 million, the SEC doesn't even care. They're like, you get zero, you're completely under the radar screen of the SEC. Reporting, all of that, compliance, all of that, you can get away with anything if you're it's either 100 or 25 million. I don't know. It's been a while since I've looked at the rules of that space because I haven't been in it. So if you're playing down there, you're a tiny, tiny institution. You might as well be retail. Uh, okay, so hopefully that was a thorough answer. Okay, so let's see. SB, good to see you. Gotta go to another commitment. All right. All right. Thank you. All right. Have a good day and weekend. Thank you, Barry. Thumbs up would be great if you're if you're getting benefit from this. Funny. What's funny, Adam? The Fartcoin or my opinion on cryptos? Okay. So, good questions. I did promise that I would answer a couple of questions during this session that I got from emails. So I'm going to go ahead and do for the rest of the 20 minutes that we have left, I'm going to go ahead and answer those questions. So the first question I got was regarding how much I would allocate to the comment about altcoins. Yeah, okay. So let me open up a Word document. Okay, so the question was how much would you allocate to morning payout plan? So remember, we were talking about a small portfolio and how to build a long short portfolio. And what I shared, just to recap real fast, is I shared with you guys that you never want in a small account, sub 10 million, definitely sub 1 million, that you never want more than 7 positions, or not 7, 10 positions. I got confused by what I was typing. So we don't want, and we never want to hit a score. We want our score to stay between -5 and 5. And the way that we calculate our score is how many bullish positions we have versus how many bearish positions we have. Okay, so if I have 5 bullish positions and 5 bearish positions, I've got a score 0. My portfolio is neutral. And what you'll notice is that it's not really possible for me to hold, if I stick to this, then just say I have, how do I get a score of 5? Well, that means I have 5 bullish positions, or I have 6 bullish positions and 1 bearish position. That's possible. And so we had another rule on top of this, is no more than 5 bullish or bearish positions at a time. Okay. So that limits me quite a bit. And there was a lot of reasons why. And if you need to know why, then go back to, I think it's a week and a half or 2 weeks ago now, where we started talking about this. So with this as a rule, then the question, now we have a context for how would I allocate something like the morning payout program. Now the morning payout program is neutral. It's neither bullish nor bearish. It is capitalizing on a phenomenon where the market doesn't really move that much from day to day. Now, obviously, this past week it moved a lot day to day, but the normal MO of the market is that it doesn't move that much day to day, and so therefore it's taking a neutral position on the market. And there is a study on the morning payout program where, because of certain characteristics about the morning payout program, meaning that it can go on long win streaks, it has a very well adjusted reward risk ratio, for its win rate. And so it actually has very small drawdowns. And anytime we draw down, it's recovered very quickly. In general, if we lose a day, it recovers in 1 to 2 days. And if we lose a cluster of days, if we lose 3 days in a row, we generally make it up within 2 days. So, or 2 trades, which is 2 days. So these characteristics make it an excellent compounding system. And I've shown multiple ways where it's been able to compound. Like I showed you guys compounding a $1,000 account all the way up to $4,500 in a couple of months. And then we had Richard share with us that he compounded a $400 account into I think it was $1,200 in just a couple of weeks, or 3, 4 weeks, I think it was. So it's very, very, very good at compounding. So how would I allocate this to my long short portfolio? Well, I could choose not to compound, in which case I could just add it to a slot like this. It's neutral. It occupies one slot in my account, and it is neutral. However, what in the morning payout program, I share with you guys studies, compounding studies. And that compounding study showed how a $1,000 investment over a 2-year period and with in multiple 2-year periods, but most relevant is from 2023 to 2025, January. In that 2-year period, if we allocated 1/3 of your account always compounding to morning payout program, then 2 years it was able to compound $1,000 to $116,000. And I really love that study, and that was the basis of me doing multiple examples of compounding $1,000 into $4,000 plus, the compounding a $2,700 account into $16,000. It was all on that basis. So if you like that study as well, like I do, then what I like to do in an account, in which I've done exactly this a few times, is I go with morning payout neutral. I allow it to occupy 3 of my slots. Okay. And so that way I can start to compound this little area, this little section of my portfolio. And because of its rules and the way that it draws down, it never has a huge drawdown effect on my portfolio. Even at 1/3 of my portfolio, it never really cools my entire performance down too badly. Okay? On a $1,000 account, yeah, that would be no. Well, the study would say yes. So if this was a $1,000 account, then each one of these 10 would be $100 per slot. And therefore, this allocation would be $300. It wouldn't be 333 because the way that we've broken this up. If you say, okay, and remember that these are rough, right? You're never going to be able to allocate perfectly $100 every time. So if it ends up being 105, 110, or $90, then that's perfectly fine. And this actually makes sense for a $1,000 account because generally the minimum allocation to a morning payout plan trade is actually right around $300. Okay, sometimes 270, sometimes 350, the 360, right? So this allowing myself 1/3 of my portfolio or 3 slots in my $1,000 account allows me to actually participate in the morning payout program, even with a $1,000 account. Otherwise, it would have to be, right, 3 times that would have to be a $3,000 account, at least, if you're just only doing 1 slot of morning payout program. So what does this mean then? Okay, so this so far is 0. And let's just say I want to, like right now, our opinion is that the portfolio, our opinion is slightly bullish. And therefore, my portfolio should be at a +1. Okay, so I just occupied 3 slots there, but I'm still at a 0. And so if I want my portfolio to be a +1, then that means I need to allocate $100 to a bullish position. That would put my portfolio at a +1. However, it is pretty difficult to only allocate 100. Okay, so what I could do and still be a bullish +1 is I could do this. So if I can allocate $300 to a single position and then $200 to a bearish position, that puts my portfolio at a +1. But then you'll notice I don't have room. Like basically I can never fill my slot number 9 and number 10 if I do it this way. So this is how we handle really like small accounts, like $1,000 account. That is very difficult to allocate for because $100, there's just not a lot of $100 trades out there that we can trade. Okay? So hopefully that makes sense. What I wouldn't want to do is just do one $300 bullish position because that puts my portfolio at a +3. I'm overly bullish. So if there is a Liberation Day event, if there is a COVID event, then what that means is it's going to wipe out my bullish positions, but it's probably going to wipe out my neutral positions too. And so suddenly I'm down 60% on my portfolio. Potentially, if these all go to zero, I'm down 60% on my portfolio. I only have $400 left. So I don't want to do that. I want to do this. Okay. Because if these get wiped out, I'm out $600. If they get completely wiped out, I'm at $600. But if the event is so big that it causes all of these to go to zero, then it is a really, really good event for these two. These are probably going to not just double. They're probably going to do more than double. Okay, so this doesn't just balance out these two, and then I lose on those four. What should happen, like if it was a COVID or a Liberation Day event, these things triple or quadruple or more. I had many positions where not many, I shouldn't say I didn't have that many bearish positions on at the time because my portfolio was pointed upwards, but I did have bearish positions, and those bearish positions went up between 4 and 10 times. They made 400 to 850%. Okay, so not, I said 10 times, I should have said 8.5 times. Okay, so they went up 400 to 850%. Okay, so even if all these were, well, it doesn't matter. These are 6 losers, right? Or sorry, yeah, 6 losers. If I have 2 of them that go 4x, that's like having 8 winners. So I have 8 winners minus 6 losers. I'm net positive on this. This is why we build long short portfolios in small accounts, because you got this natural hedge here so that if things go exactly as you expect and things are bullish, even if I lose these two, I'm going to win these two. Okay. And then I'm going to win this one and I'm going to be net positive. And probably I'll win these two. So I'll be net positive. Okay. And if there's a COVID event, then these things are going to blow way out. All of these are going to go to zero, but these are going to blow out so much that my portfolio is still positive. This is exactly why we do the long short portfolio. The only like terrible, terrible, terrible case scenario is that the market does absolutely nothing. If the market does absolutely nothing and I eat away all my time decay, then all of this, assuming that I'm only doing single options positions, well, then I lose on all 5 of these. But guess what? If I don't stick to single option positions and I do verticals, I'm going to win all 5 of these. I'm not going to, right? Because a neutral movement, if I structure my vertical correctly, a neutral movement is still a win. Or if I do butterflies, or if I do other structures other than a single option, then that doesn't have to be a case. A neutral thing doesn't have to actually blow me out. But just say I do only do single option positions. Okay, so this goes completely sideways. The market is completely neutral. It goes zero. Every single one of my positions, the underlying stock moves exactly zero. Then I lose 5. But at least I've got these 3 MPP trades that are making up for them. So actually, assuming that they are 1-to-1, then I lose 2. Not so bad. My portfolio is down 20%. 20% is easily recoverable. Okay. I don't have to make like 30% on my portfolio in order to make up for that 20% loss. Right? So that this is the benefit of a long short portfolio, and adding in something like the morning program where you have neutral positions. You're adding that neutral position, that income position. And this is exactly what I was talking about the last time, at the end of that segment where we're talking about the portfolio building. If you add in neutral positions, you add in an income into your portfolio, it will smooth out your equity curve. Okay, because if and something goes completely sideways, you're not going to take a big hit because your neutral positions will win. So a properly constructed long short portfolio will have neutral positions, it will have bullish positions, it will have bearish positions, because that way you're maximizing the probability and possibility that no matter what, you're at least going to make a little bit of money. That's what we call a smooth equity curve. You're not jerking up and down. Okay. No matter what the scenario is, the very high probability is that I'm still making money. There has to be a very special set of circumstances for me to lose money. And there are 0 circumstances in which I can lose every single one. Right? So that's what gives you that smooth equity curve. And that's exactly what we want to build right here. So MPP is a very, very good program to be putting in to your portfolio. And it makes sense to allocate 33 slots to it because of the study that we did. And actually, I'm showing you that is actually very practical. It was a very practical study. It wasn't randomly done. I didn't choose 50% on that study, right? I didn't choose 70%. Let's compound 100% of our account using MPP. No, because it would not make sense for a long short portfolio. Every program that I put together is very carefully constructed with the mind of a small retail investor, with the small retail investor in mind, building a long short portfolio. That's what you'll notice. If you buy every single one of my programs and you put all those in together, you are automatically going to build a good long short portfolio. Actually, recently we haven't had that many bears, but I haven't been super bullish either. I haven't issued a billion bullish positions. I only issued 1 or 2 at a time. So if you had all of my programs, you would be naturally building and you didn't have anyone else's programs, you had only my programs, you would be naturally building a nice long short portfolio. Okay, and that's my hidden agenda behind all my programs. The next program I release will fit in there also. I don't release programs just because, hey, here's an edge and I can sell it and people will buy it. No, I keep your retail trader long short portfolio in mind when there's so many programs that I could release. I've got a list of like 30 that I can put out there with excellent win rates and excellent studies and all of this. But I don't put out 30 programs because you're not going to build a good long short portfolio that way. If you buy 30 of my programs, you're going to be clustered. Probably you're going to be overly bullish in most of the time. So I don't do that. I only have 4 programs. I might release a 5th and maybe a 6th in the next year. I don't know, but only if it fits into building a nice, good program, a nice long short portfolio. Okay, so this is how I think. This is how I operate. So MPP fits 1/3 of your portfolio beautifully, as long as if you're operating in this style with a score of -5 to 5, more than 5 bullish or bearish positions at a time, and you're allocating 10% per slot in your portfolio, then MPP, if you allow it to take 3 of your slots and you're building long short on the rest of it, then you're going to have a really well balanced portfolio for the score that you're looking for. Okay, so let's see what you are saying. If I don't have spread ability account, how would you convert a spread in just alongside for a similar return? If you're talking about MPP is any neutral trade is dependent on spreads. So you're not going to be able to put neutral trades into your account if you can't build spreads. So then you really need to match up your bullish and bearish trades well, okay, and make sure that you stay at your score. Okay, hey Tom, okay. Sent you an email with compounding results in simulation. Okay, great. And I'll take a look at that. Only half of one slot. Okay. I have VIX called as one of my bearish slots. It did very well this week while my mineral stocks dropped on Wednesday. Yes, perfect. That is exactly what we were talking about here, where the bearish ones, they protect you on that downside. And generally, if it's a huge move, then where it would actually take out 100% of your bullish trades, then your bearish trade will more than make up for that. Okay, I'm loving the MPP and QuantX. Oh, great. Thank you. We appreciate your focus on smaller investors. Thank you. Oh, you're very welcome, madam. Thanks for your expertise. You're welcome. Would you suggest that I exit Gamma program and enter MPP? If you have no income programs and only directional programs, I would try to get an income program in there. And if you have multiple directional programs, yeah, it could make sense to replace a directional program with a income program. Absolutely. Okay, so we're at time right now, and I didn't answer the second question. So let me remind myself what the second question is and figure out if it's going to be a long answer or a short answer. Give me just one moment while I figure that out. Okay, yeah, it's going to be a long answer. So I will do that on Monday. Okay, so we'll end here. And if you're, who is it? I'll answer the second one on Monday. Okay. All right, guys. I hope you have a wonderful weekend. I hope you learned a lot today, and that you did just fine throughout all of this volatility that we had all this past week. It does look like we're going to continue with that volatility next week, and so we do need to be careful, and we do need to modify our trading. On Monday, if you attend the Gamma report, I'm going to be talking about butterflies and how they are excellent for the current environment. They're excellent in the normal environment, but they are like perfect for this high volatility environment that we're in right now. Okay, so I hope to see you on the Gamma report on Monday. I hope to see you in the post-market live stream on Monday as well. Have an excellent rest of your weekend, and I'll see you guys later. Okay. All right, bye guys.